Welcome everybody to the webinar, Operational Efficiency and Accounting Investment Analysis for Single and Multifamily Offices. Thank you for joining us today. I am Mike Slemmer, Chief Operating Officer for FundCount, and I'm very pleased to have with me today two experts on this topic and about single and multifamily offices generally. First, Steve Harris, the CEO of Clearview Financial Media, and also Paul McKibben, Executive Director, Family Office Practices for Ernst & Young.
Good morning, everyone.
Good morning.
So let's talk about what we will be discussing today. First, we'll set the stage with the purpose of this research. Why did we decide to undertake this to begin with? Steve will talk about methodology and segmentation. We were very pleased here at FundCount to partner with Family Wealth Report and Incisive Media, and their excellent research team led by Wendy Spires did an incredible job in gathering data, assessing that data, and providing what we think is a top-notch report on this topic. Next, we'll get into the data. We will not go through the entire report, but we will be talking about specific areas of the report that are most, we think, are of most interest to you. And then we'll also tell you later on how to download the whole report if you have not already. And then what we're calling final words of wisdom. We have some recommendations that if in fact what you hear today is important to you, just some thoughts about how you might move forward. And we've left plenty of time for Q&A. And so our prepared presentation will not go, obviously, the entire hour. So first, let's talk a little bit about the purpose of this research. It's interesting to us, certainly here at FundCount, that there are many ways to gain alpha, and of course, the major focus on gaining alpha is in your investment activities. You can go to any number of conferences across the single and multifamily office industry, and you will find most of them are very focused on investments. And of course, that makes sense. Now, everyone likes finding that diamond in the rough, that new undiscovered asset type that will outperform. So whether it's just beating a benchmark or looking for new assets that offer greater risk-adjusted returns and diversification, it is investments per se that are the prime focus. But what did Jack Bogle preach? In our experience, family offices are, of course, highly focused on gaining alpha, but exclusively on the investment side of that notion. Jack Bogle, as you may know, the leader of the index industry fund, low-cost investing, and bringing investments to the masses through Vanguard and his low-cost funds, was highly focused, like a laser beam, on the operational side of providing good investment options for his investors. And that, in fact, is what we mean by operational alpha, being able to increase your investment returns through the efficiency of your operations and keeping costs down. So in our experience, far too many family offices just don't care enough about this inefficiency, and thus the wasted money in running the family office. So here's an example. What we'll call alpha left on the family office floor. Now, this is an actual diagram drawn by a family office. It was done by a industry consultant named Philip Boxer a few years ago, and it's in a heat map format. So this family has many concerns and process flows. Some are quantifiable and can be addressed by software or other systems. And some are really the soft issues. Things like protect the legacy up there in the top right, governance, family mission. So certainly a system can't solve all the problems that you see in this diagram, and certainly can't be solved all with one system, but an integrated approach, in our experience, can enhance and does enhance efficiency and help to reduce cost. Now here's another family office. This one, in fact, is now a FundCount user. We got this diagram during their buying process. And this is a more typical depiction of the type we receive. It shows investing and operating company flows. And I'll ask, even though you're all on mute and you can't answer me right now, if anything jumps out at you. Yes, there is the look and feel of a number of systems, an array of systems, all working together very nicely. But in fact, the only true glue in this situation is people. There are, in fact, 16 manual processes that that we found with this family office. So with that as the backdrop, and the reason why we wanted to do some deeper research on family office and multifamily office efficiency and operations, and how we might be able to learn more about how we could help, let me now introduce Steve Harris, who will talk about the data and what the methodology that was used in doing the study. Steve?
Excellent. Thank you very much indeed for that, Mike. And may I say, it's been great to work with you guys at FundCount on this research and the report that we've done with you. So the data points for the research came from a detailed survey of 44 family offices globally, and the research was carried out between November of last year and January of this year. There were also around 20 senior family office executives who provided insight through face-to-face and telephone interviews that we did. And this amounted to roughly 10 hours of research in total, plus the questionnaire and the survey. And in total, these family offices represented around $72 billion in assets under management. And whilst you can see that most of the firms were from US and North America, there were a good number from the rest of the world as well, and other jurisdictions. So in terms of assets, total assets under management, if we look at the pie chart here, what have we got? The biggest group of all is the 250 to $1 billion asset under management group with 34%. Next up is $1 to $3 billion AUM, and that's 25%. Going down to 50 to $250 million at 18%. $3 billion plus is 14%, and 9% is representing the 50 million and below figure. So interestingly, they're very, very complex, this group, and what we found is that 44%, a total of 44%, manage more than 26 entities, and that was something that really staggered us when we discovered that figure. And almost 2/3 of SFOs, 65% included in the study, have more than 26 legal entities. Half of the FSOs in the 51 to 250 million AUM bracket, and 3/4 of those managing $250 million to $1 billion have over 26 legal entities. Our research shows also that alternatives allocation is generally over half of the total, with SFOs being substantially more adventurous than MFOs, and that's in the slide that we're looking at now. The family offices included in this study had an aggregated 53% exposure to alternatives, and by alternatives we include private equity, hedge funds, direct investments, also including real estate companies, not real estate itself. So meanwhile, multifamily offices are allocating 44% of assets to alternatives, and single family offices are allocating 60%. Within this, MFOs were found to have allocated 17% to private equity or hedge funds on average, rising to 21% to these things for SFOs. Direct investments, including private businesses and real estate companies, stood at 27% for MFOs and 38% for SFOs. Now, interestingly, the interest in cryptocurrencies has yet to translate into an absolute investment, with holdings we found to be negligible within the whole sample. So we offered 8 choices, and could pick up to 3. So this, I think, is on the next slide. What are the biggest weaknesses of your system? We asked respondents to pick up to 3. So manual processes, prevalent, difficult to process, customized or ad hoc reports, inability to account for, analyze and report on all investments in one system, Excel and QuickBooks still necessary, custodian, broker, investment manager data not automatically aggregated and downloaded, cost, lack of consolidated look-through reporting for family and subgroups across entities and investments, and other. So, of these choices, which were the 3 biggest?
Thank you, Steve. And the 3 that were cited are these. Manual process is prevalent. 83 of the responses, 83 cited this as the #1 issue. Excel and QuickBooks still being necessary in their processes. And the inability to account for, analyze, and report on all investments in one system. And a close fourth was difficult to produce customized and ad hoc reports. None of these issues as weaknesses were a surprise to us here at FundCount. Paul, what do you think about this?
So 2 things. One is, I think that in a way the close fourth says it all. I mean, at the end of the day, the family office is driving toward the ability to control their portfolio, right? And to see through in what they have. And so the inability to get reports is almost always the driver that brings families to us, for example, and looking for new system solutions. They worry about costs, they worry about the systems, but they begin to worry about it truly when the reporting doesn't meet their needs and when they have a bad experience as a result of that.
What are some of the, that's interesting, when you say bad experiences, what are some of the bad experiences you've heard?
Responding too slowly to market concerns, or actually I heard one just the other day. It was a gentleman that had a large hedge fund portfolio, and he had it tracked by an external advisor, and well after it was already a risk concern, they brought in the news that several of his hedge funds had very much drifted away from the style he expected from them, and moreover had lost a great deal of the assets that they had had under management. So that kind of a risk factor, and looking at the underlying assets and looking at the managers that you have and knowing what they're doing, needs to be information that you have early on, not late, right? So the ability to do custom reporting and see through things is crucial to that.
Right, exactly. Yeah, very, very good example. And certainly we also here, just focusing on that Excel, QuickBooks still necessary. issues such as just the lack of data, checking data veracity, auditability of those data, especially out of Excel, less so perhaps in QuickBooks, but just an absence of the guardrails around the data is often something we hear as a concern, which obviously then factors into difficulty in producing reports or
I
reports that are
agree.
accurate.
And
Yeah.
and I would say there was a study I saw recently. It was from the European Union, but the material error rate in complex workbooks, complex Excel workbooks, is well over 90%. And so if you look at sort of mission critical applications you're running in Excel, you would expect much better from a system than that. But with Excel, it's just sort of the way it works. You know, if we make a change or we have to um, keep it up to date and you know the data rolls or anything like that, we begin to get material errors, and something you have to accept with Excel, but you would never accept that
Mhm.
from a system.
Right. Wow, 91%. That is not a trivial number. So great. Well, thank you, Paul. Let's move on to the tools and or systems that were most cited by our respondents. And we asked, what is the main system you use for portfolio accounting, that is for marketable securities, for partnership or investor accounting, that is more or less for private types, for general ledger accounting, and for general cash management, i.e. accounts payable and receivable, check writing, bill pay, etc. And we also asked about systems used for reporting. So we got answers in all those categories. And then we asked, so of all of these categories, which one of these systems, which category do you consider most critical to your operation or otherwise use the most? So I'm going to give you all a minute here to look at everything on this screen. And then I'm going to ask, can you guess which ones were cited the most? And probably many of you are going to guess it. But the answer was the quote unquote systems of QuickBooks and Excel. So again, no surprise to us. At most of the family offices and even a lot of the MFOs that we work with, it is some combination of QuickBooks and Excel and maybe an array of a few other one-off systems that are the most used and the most dependent upon.
And Mike, I would say if you go back to your diagram, if you think of the diagram that you showed where you had the sort of the number of systems that looked like they were working closely together, but there were actually 16 manual interfaces. At the end of the day, those manual interfaces were probably, you know, relying upon Excel, right, for modeling things and bringing it in. So Excel is the glue that takes the place of, you know, proper integration in many ways in a systems world.
Mm-hmm. Yeah, that's interesting. You point that out. I should have pointed that out on that diagram. If you look at it, Excel is injected into several parts of that diagram. So you are very correct. And I think, though, too, one thing that jumped out at me from the many quotes that Wendy and team were able to get in their follow-up phone conversations was this one jumped out at me. Our portfolio management system is more designed for a single strategy manager. It's not well designed for also investing in cash, bonds, private equity, and hedge funds, and trying to report on that through a single system. It's not at all user-friendly and requires a lot of finessing to operate. And we hear this often as well, that heritage does matter. You can try to retrofit a system for some of the other investment types, or for instance, the cash management aspect of operation, and it is difficult unless the system kind of organically has that from the get-go.
This is a great quote, and I would say that when we're asked to look at, you know, making changes in a family office, it's often because they've taken a special purpose system, you know, something that was a single asset class system, and tried to sort of poke everything into it and make it fit. And they've gotten themselves to a position where, you know, they can no longer function. And you know, it's indicative of the marketplace. Family offices are a difficult clientele. They're hard to find. There aren't that many. And so a firm that has a focus on this and really truly understands the nature of the client is important. People build systems for fund managers and for private banks and for RIAs. And that's a very different world than the family office operates in. So I think this is a great quote, and it's something that everyone should think about when they look at systems in particular. What was this built for? Is this somebody that's stuck with this market over time and knows about it and shows a commitment to it?
That's an excellent point. Yeah, thank you. Let's talk about reporting, and also somewhat, well, I guess surprising, but not really, was it does foot with the other data around individual systems, a lot of one-off systems. But we asked, in asking about what reporting tools do you use, we found that 70% of the respondents are using non-specialized systems. So in a lot of cases, that means Excel. It can just mean general reporting tools. Maybe they're building something out of Power BI or Microsoft Power BI or one of those general tools. But point being that, again, back to your point, Paul, specialized and what the vendor is focusing on. You're looking for things wholly focused on the MFO and SFO needs. Only 11% are specialized family office reporting tools. Some are proprietary. I guess we can talk about specialized wealth management reporting as getting into that world, but the vast majority at 70% is just this general amorphous tool set.
Right. Well, and like all of everything you point out is that family offices have a particular information architecture, right? They're multi-asset class. They tend to be heavily centered on alternatives. They're held inside of complex structures, right? Lots of entities. And so those other tools, again, they're not built for that purpose, right? They're built for high volume reporting to registered investment advisor clients with simple accounts and things of that nature. So the information architecture of the family office needs special reporting. And this is why I think so many family offices are frustrated when they come to reporting, is they haven't sort of picked tool sets that understand the information architecture of what they do, right?
Yes.
So and again, this is sort of throughout your presentation is like, look, there's an architecture here. We understand it, and most of these tools won't consider it.
Yeah, and I think back, Steve, to something you talked about in the data set or the characteristics of what we found. And most of the family offices that we glean this data from are very complex with many, many, many legal entities and many nested entities. And right, and what we find in reporting, and probably where the rubber really meets the road, is when a FO wants to report on many layers through generations or entity layers and be able to ascribe the beneficial interest down through those layers. And we repeatedly hear of people, taking the razor blades to the wrists when they're trying to do this in Excel or some other general purpose tool.
Yes, we
thankfully we were able to, stifle the bleeding there with the
talk them off the ledge.
Talk them off the ledge, exactly.
Indeed. Yes, we were, as I was saying, we were staggered that, as I said, 44% manage more than 26 entities. That's a large number.
Yes, exactly. So anyway.
Well, and don't underestimate what you said about, single asset class systems as well, right? We don't measure risk and performance the same as we move from hedge funds to private equity to direct investments or back to fixed income. So again, specialization matters in this realm because of the tiered ownership structures, the multi-asset classes, and Mike, what you said, the reporting perspectives, right? A system that's built to report on single accounts is not something that readily can be made to look through a generational structure or a household structure. So all of these things impact, the family office.
Absolutely. So this next area was really interesting to us, and certainly one that we hear many, many times, and that has to do with the hours in the week and the amount of hours in the week that are wasted on this situation of having so many systems and having to glue and kludge these systems together and processes together. So I'll ask the question again. You all can take a guess as to what percentage of a 40-hour work week our respondents believed is wasted by all their personnel on manual efforts. And it was a pretty amazing statistic. So almost 3/4 of our respondents said that 10 hours or more, in other words, 20% of a work week, are wasted on manual processes. Paul, what's your experience?
So I would love to hear, Stephen, you were the researcher, and if anything, I would guess that this is understated, right? Because nobody wants to admit how much time they're spending on this, but I think that time spent on manual processes or semi-manual processes is very large in family offices. It's how things get done, and I'm curious, Stephen, if you know, like, when was the category 10 hours or more? In other words, could they have chosen 20 hours? Because
we asked a specific
Yeah.
number,
no,
I think you're absolutely right that the embarrassment factor would come in here for sure, and people would want to overplay their efficiency rather than the other way around. So yes, I would say that this is a slightly underreported figure. Yeah, definitely.
and it compounds, right? So if I'm spending 10 hours on manual processes, not only am I impacting, the wait time for people that rely on things, I'm also creating errors, which then require correction. Is any manual process. So, but anyway, I laughed at that and I thought, well, I hope it's only 10 hours. But the point is, it's very material, right? It's very material to what they're doing, right? That's
Exactly.
a large number of hours for anyone to report.
Yes,
And that's a good question about what the actual question was. Perhaps we can answer that later in the webinar. But it was more categories. It was broken down, I think, into five, I think, different segments of hours. So we just aggregated it based on these two more or less extremes, I guess. But we can check on that.
Well,
so let's talk about KPIs. So we're getting all the thoughts and the data around maybe what's wrong, what should be improved, but okay, what's the benchmark for it? What is in fact the way folks look at the world? What are their key performance indicators for their SFO or MFO? And we gave these choices and then a general other category. So time to reconcile data, time to produce final reports after a period end, the accuracy of those reports, family member or investor satisfaction, investment portfolio performance, time required to make an investment or business management decision, the overall cost of operations. So let's look at what the respondents said. And here we've summarized the top three. There was a tie between these two bars on the left: family member or investor satisfaction, time to produce final reports after period end, report accuracy. That's a recurring theme throughout all of these questions, and then cost of operations. So no surprise to me here. Those two that are tied are I would have to say kissing cousins. That if you're going to have family member or investor satisfaction, you better be quickly and accurately producing reports after period end. They better be accurate. So no surprise in those top three to me.
Yeah, and let me just say that I applaud the whole notion of introducing, key performance indicators into these questions, right? I think that this is this was probably a question that they were thinking about for the first time. My experience is that these sorts of hard measures are not often in place in a family office. What happens is episodically they run into a problem, right, and they find out, hey, our cost of operations have scaled up, or gosh, we can no longer get the reports before the 30th day of the month, and things like that. But I think the idea of putting KPIs into this, right, and asking these questions up front and saying to family offices and hopefully beginning to gather regular data on this and saying, look, what do you experience in these areas, before and after an implementation, or as time goes by, or as you shift from asset classes. This is a terrific idea to begin to measure these things. Family offices are hard to measure and know.
And I think it also plays to the idea of what is the most important thing for you to keep your job. The cost is one thing, but if you get it wrong, or if you don't keep people satisfied and on board, and if you can't get things them on time, then your job is at risk, isn't it? Cost control and cost reduction are great, of course, but they're not perhaps mission critical in terms of whether you as an individual keep your job or not.
Very, very good point.
One thing, I agree completely with what you said, and I think that one of the things that struck me as I looked at these were that these might have been reported in a way from different perspectives. In other words, if I'm the CIO of a family office and I'm responsible for investment decisions, the timeliness of my reporting, right, makes all the difference in the world. I need to know, on a flash basis, what's going on in this. Family members are often, extremely focused on the nature, the quality of the report. I look at it and I see it and it's wrong. So now I don't trust my office, right? So I think that when you say keep your job, right, there are different views on this. There's the accounting view that says it has to be accurate and it has to be reportable and it has to be kept up to date, right? And then there's the CIO who says I have to make decisions and things depend on those decisions. And then the family member who says, look, like in that first slide, you showed with all of the complexity, right? Despite all of this mess, am I getting what I need, right? Am I actually making money, or am I, is my cash balance correct, or am I able to do things? So I think it's kind of fascinating because this could impact any area of the office: the accounting operations, the finance operations, the portfolio operations, the client satisfaction, and all of these things tie together. So this is, again, I say this is a terrific idea to begin to introduce these KPI measurements into this world, and I hope this is something that will go on.
So that's interesting. I'm interested and surprised to hear that you don't experience this much with your clients. So does Ernst & Young, do you folks then work with them on instituting KPIs, and how is it received?
We do. That's a great question. I mean, one of the things we do a lot of is leading practice studies for single family offices, because we have a lot of cases that we've seen, and we see a lot of things. It's a private world, as you know. And so, but our data are drawn from case studies primarily. This is almost the first survey information I've seen that's actually gone out to the market and said, tell us these KPIs. And in fact, that's something I'd like to see. I'd like to see more of it, because then we can tie our work to it and say, look, relative to the marketplace, right? The surveys done last year, by FWR, this is where you stand in this area.
Right.
So, but yeah, we do look at these things, and they're hard. Cost of operations is a hard measure. There's a big range for this, and it depends on how you focus it. Does it include concierge, or does it include only the investment, management process and things like that? But all in all, I particularly like the simplicity of time to produce final reports and things like that. And
But Paul, do you recognize too that things like accuracy can be impacted by time, and there could be an inverse relationship between the two, and perhaps if you are focused on time, then you've got to manage expectations in terms of accuracy, or perhaps completeness, and perhaps have a level of materiality that you put into the reporting structure to take account of speed being the number one driver.
Absolutely. And I often find that an office will have one focus or the other, depending on sort of how it was built. So like if it came from a tax perspective or an investment perspective, materiality is the threshold, right? But if it was driven by the accounting that needed to be done, it's often driven by accuracy, and the two often don't talk to each other, right?
Yeah.
So you're right that, I mean, in a way, what the family office wants is both, right? We want
Right.
material information in a very timely way, and then the accurate information to come when it's available, right? And then we want those two reconciled over time. So you're absolutely right, Stephen. Those things are both important, and I've almost find it a perspective, right? A stakeholder perspective. We always encounter often that what we call the CIO's perspective, the investment perspective, is very different in many cases than the accounting perspective, which in turn can be different than the family's perspective.
Yeah.
And so understanding all three of those in this process really leads to better definition of what you actually need when you buy a system and when you put things in place. And so anyway, I don't want to take us off track, but I think that's a really good point. And this, like I said, is a great outreach to the marketplace to say, look, these are things that matter, right, in your long-term success, right? Let's begin to measure them, begin to report on them.
Great, super. So let's move on to, this is actually not in the report if you download it, but it is interesting because it is consistent in a different way with a different set of questions that we have asked of our own clients. And we surveyed our clients a week in the life, so a 40-hour work week, both before and after implementing fund count. And you can see here in their pre fund count life, so using QuickBooks, Excel, hodgepodge of systems, this is the way it broke down. 8 hours reviewing client portfolios, 8 hours speaking with clients, but 8 hours in administrivia, 8 hours working with Excel and QuickBooks, 6 entering data into multiple systems, and 0 in free time. But in the aftermath and after implementation, after go live, what we again heard from our clients is there was a big jump, doubling of the high value activities of reviewing client portfolios, speaking with clients or investors or family members. Administrivia and working with Excel, QuickBooks dramatically decreased. Entering data into multiple systems went down to 0, and they even got 4 hours of free time. So there is real benefit from making the change. I mean, certainly any change and approach and systems involves a bit of pain, but ultimately our experience is that it results in a much better life afterwards.
Yeah, it's really, you've sort of shown a direct measure here of return on investment, right? So it's not trivial to put a new system in place, and there are change management, and there's people's feelings and time involved, but this is a direct measure of the return on investment. I would say, keep up the good work, because what you're not showing here that is probably the most important thing is if I'm reviewing client portfolios twice as often, and I'm speaking with clients almost twice as often, and I'm focused more on less trivial things, it means I've got better performance and risk management. I'm making better investment decisions, and I've probably got better control environment overall, right, for the family.
Right.
So those are the side effects, but at the end of the day, this is direct measure of time, and the time is now being put into things that control risk and that enhance alpha, as you say, so this is this is a very important finding.
Yeah, we thought it was interesting and very, again, consistent with the research we did with FWR. Let's return to that list of systems, and now we're taking a look at them in a specialist versus generalist view, and we'll talk about what we found. And this was, again, going back to the list of, after asking those category by category questions, what do you use? And then we asked, what is the singular system, the most important system to you in your overall operation? And these were the answers we got. So let's take now a different view of these systems. and that is breaking them down into specialist versus generalist systems. And it really breaks down like this, by, again, as best as we can assess and by listening and talking with folks like Paul, as to their experience working with systems and recommending systems. Um, so, Paul, any thoughts on this?
Well, so first, this is a very good way to think of it, right? Because it highlights the problem with talking about family office systems, right? I mean, in many ways, if your first step is to go to the web and say, show me the systems that work with family offices, you'll get this list, right? But it won't tell you what they really do, and it's more of a marketing strategy than it is really a way of looking at what you need or functional. So this is actually a very good way to look at these systems. I would say that I'm curious, Mike, when you did the first run at this, the question was, which systems do you use the most? And it was Excel and QuickBooks, right? Both two very
Right.
general purpose,
Yep.
very, very, very flexible systems with almost no controls attached to them.
Right.
And
Mm-hmm.
so as you look at this now, like if sort of if you had asked the same question after you had put your system in place, would you now find that they were more focused on um, the control, the more control-based system, fund count, and that they were much less importance on um, the ability to move data manually and stuff like that. So I think that's one thing. One of the questions I have about this is, you're a comprehensive system. Sometimes you're going to come into a family office and they're going to have other pieces in place already, right? And I don't think that's a bad thing, right? They've already
No,
got
right.
QuickBooks
Uh-huh.
or Xero, and
Mm-hmm.
they're already running things like tools like Morningstar, And so, what do you do in that case? You're a modular
Mm.
platform. How do you sort of ease your way into this? And because I have seen your system come in and in a focused way as well. I've seen you come in as a overall solution, but I've also
Mm-hmm.
seen you come in and say, look, we'll take on the marketable securities piece. Will fit into
Exactly.
your overall
Right.
architecture. And if
Right.
it's all right, I didn't tell you I was going to ask this, but I'd love to hear you comment on that.
Oh, way to surprise me, Paul. So, yeah, no, it's a good question. I don't want to really stay too focused on what we do for this general discussion, but we and I'm sure our competitors here uh, do this to some degree too. But we're very focused on integratability. So we have some great extract, transform, and load tools, meaning that data can be consumed by fund count in its native format, and we will do the translation, as opposed to saying, nope, data has to come into fund count in our format. And likewise, export. So whether it's using XHTML or basic Excel flat files or whatever, we're quite good at integrating with other systems. So we really take folks where they're at, and with the systems, if they love some different systems, be it Morningstar or QuickBooks or anything, even though we've got a GL, we'll say, okay, we'll just send all those files over to whatever system that you need for bespoke purposes. So,
Right.
obviously, and again, I think many of the folks that we compete against are of the mindset that we work in an age where the technology allows us to be very integratable, and we want to meet clients where they're at.
hmm
Yep.
But you may give more credit to the field than I do. I think that Mike, I would say that I think that that's a good approach that you're describing, and one that we always sort of encourage, which is to say, look, this is a complex operation. It grew up over time. Maybe they didn't make good decisions over time, or maybe they changed their focus and they used to just trade bonds, and now they're
Right.
heavily into direct investments. But I think that sort of we'll look at the broader approach and we will fit ourselves
Mhm.
into it. And over time, you're going to see the benefits of using a single system, right? But I think that's a
Right.
very good approach to this field
Right.
because it sort of recognizes that family offices are small companies that grow up over time and with almost always, very limited resources to do what they're trying to accomplish. So anyway, that's one of the things that struck me here. You're a comprehensive platform. You sort of can hit in all of these areas, right?
Yeah.
But you may
Yeah.
come in and find, well, there's a piece already in place, and that's okay, right? Over
Right.
time, we'll fit into what you're doing, and we'll take a broad look at what you're doing
Right.
first. And I think that's a good approach. to
Mm-hmm.
this.
Yeah. No, thank you. Yeah. Okay. So we're getting towards the end here, and we're looking forward to having and hearing your questions. But I guess all this is to say that you can, with some change, get that operational alpha. You can increase efficiency. You can gain new insights through better and more accurate reporting. You can reduce the cost overall, vendor or technology cost, as well as cost based on efficiencies and manual effort. And that's just something that we see happen, and we again, if you're interested in taking a look at this, it can be done. We've got some ideas here for getting started. One is a self-assessment. Really, again, Paul was talking about the absence of KPIs. Perhaps start with what's important to you. What are the KPIs most important to you? And see how you're doing against them. And there is research out there uh, that is accessible about how you do in different KPI measures, and that can help you there. One thing we say, and I'm interested in your thought on this too, Paul, is the second point: ensure that you have buy-in from the very top.
Right.
And I have to say, and so I'm maybe going to poke some sacred cows here in the audience, but to be a little provocative, what I can say is that when we see a search fail or move to a certain point in their buying process and then stop or not be approved, it is because the folks in the family office are enduring a lot of the pain. They're enduring the pain that we talked about at the outset. That that 0 versus that 4 hours of free time, and it's because then it stops because they don't have buy-in from the very top.
Right.
Whether it's the patriarch, matriarch, key family members, they haven't bought into the fact that those folks in the family office have all this pain. We need a new system. So, and then that again is aligned with the third point. If you are the very top, be involved and supportive from the get-go, and then the process will happen. Any thoughts on that?
So this is again a very good list. So I would concur. Like we would typically say to a family, um, your first step shouldn't be to go to the web and look for what family office systems are out there. Start with what you do, best, right? Start with your company. What do I invest in? How do I trade it? If I'm managing real estate, am I actually collecting the rent, or is it just, an investment pool that I'm part of? And I look at it on a cash return basis. Look at how I own things, right? Do I have pooled
Mm-hmm.
vehicles? Do I come in and out of those pooled vehicles mid-month or daily? Do people pick and choose? And look at your whole situation and build a requirements definition,
Yep.
right? I think that's important because it's what and it's on your, it doesn't require you to make a decision. You can sort of thoroughly study. But the second piece is very important. I for many years was involved in corporate development type projects where we would buy companies and do partnerships. And the most important factor in success has been shown to be the degree to which you structure it so that you've got a sponsor at the very top and buy-in also from the teams, right? So on the one hand, the accountants that have to do the work need to be bought into this, right? And people think of that, but they don't always think about the problem of having a sponsor who will be there when something goes wrong, right? Or when the
Right.
cost has to be borne, or when they say, well, this is going to take a month longer. And so structuring it, and I would go for like I would go as far as to say that we would often, make the extraordinary step of saying, we really want your CEO to meet our family members. We want to make sure we're in the room together. We want to make sure that we know each other, because if we
Yes.
need a call later and say, we're running out of steam, we're going to have to slow this down, or we need you to do more and we're willing to expand this and pay more. That those decisions come from the top. The scope of the project comes from the top, and the last thing you want is for them to get tired out on this. You want
Mm-hmm.
them
Mm-hmm.
to be what they do best. You need them to be patient capital, right? You need
Yes.
them to know what the goals are and why they're doing it, and to be bought in. So I completely agree with this, and I think the the last point, you didn't say anything about this, but it's very important, which is that we find that vendors are their own best you know your system best, right? And you've implemented it more than anyone else has. And so being guided by the vendor on what they can do, but on the other hand, making sure that you, and Mike, you might not always get this, right? But making sure that you know what you're fitting into, right? This is what we want you
Exactly.
to do, but this is the overall picture. And then you may say, oh, sure, but did you know that we can also do this? Or we'll make sure we build it in such a way that we can easily
Mhm.
integrate to, these other
Right.
processes. So these are
Right.
all steps that we would recommend, and and they lead to a better selection and a better implementation and a better outcome for everyone.
Yep. Yep. That's good. And actually, no, very good points about that last bullet. And what we meant by that too is that just for some context, I've been in the world of investment technology since the dawn of time, and and what I found interesting coming into the area of working with family offices is that given how private they are, that unlike other, let's say, classic institutional asset managers and those realms where it's all about, hey, here's a needs list, here's our characteristics. And there's a lot of openness and interactivity in going through the search process for a system. It ain't that way in family offices,
Mm.
and we find more skepticism than we do openness in sharing data, telling us what the characteristics are. And, we get that. Family offices are quite private and led by very private families. But
Mhm.
that's what we mean too, that, we're happy to sign NDAs. I think all of our competitors are too, to just be open to sharing that data because it does help us bring the best solution to the table. So
That's a
that's
really good point. And to go back to this thing about the very top, any complex system implementation is really, it's not just one project. It's a portfolio of things you have to do, a portfolio of projects, and that includes preparing the data, change management, rewriting your processes, maybe shutting down systems, right, that are out there. And so again, like fitting this into an overall, saying I'm going to buy a system, but it has to fit in operationally to what I do, and I'm going to make sure I do it thoroughly and all the way, is really one of the things that having involvement at the top really enables, because at the end you'll do it, you'll finish the job, you'll get it done completely, and you'll have done all the cleanup and the retirement of old systems and everything else that goes with, the promise of putting
right.
in a new system. So I think it's a very important um, step to take. And families aren't always that involved, so it may be
Right.
a board level discussion. Doesn't have to be detailed project plan, but it needs to be a regular update and a clear sense of the vision, and a clear response from them that they're bought into the vision.
Right.
Do you think that
So
there's also
go,
a
go
problem
ahead.
in getting the idea to the very top? We talk about uh, buy-in. Do we need buy-in from people who are more at the coalface too? And don't forget that these people often are those who are doing the manual work that we are suggesting it doesn't need to be done or shouldn't be done. We we might find that that some of them feel that their jobs or their their position in the business or whatever are being put under threat. So
Yes.
do you find that that you get squashed at a lower level before those at the top even have a chance to view it? That's one point. And
Mm-hmm.
when you do get to the top, do you talk about a payback period? Do you say, look, this is well worth doing because you will recoup your investment in 5 years or three years, or
Mm-hmm.
do
Yeah, we,
you?
we very much we very much do try to focus that way.
Yeah.
That is through a lot of qualification, asking questions about manual processes and the time estimated on those and the expense. And so, yeah, absolutely try to focus on what that ROI can be.
Yeah,
Definitely.
totally
So,
agree. And I think when you go to them and asking for the support, you owe them not just a sense of what the project is and what it, what it hopes to do, but also, what it will cost. Obviously, they'll want to know, and what the payback is, right? Pro forma, at
mhm,
least, how we're going to get this back, and then what are the soft benefits, And then I'll say one other thing, which is, and also then what do we need from you? Right.
Right.
So
Exactly.
if my people are concerned that this is going to impact their jobs, who better than the family to
Yep.
reassure them that that's
Exactly.
not our goal here. This is not a
Right.
cost cutting endeavor. This is a quality project, so.
Exactly. Exactly. So in the interest of time, I'm going to just move on here, and we want to take some questions. Much of the qualifying that you can do, both of vendors and also thinking about your own needs and KPIs, can be found in this checklist for qualifying vendors and technology. It starts with a self-assessment. So if this is a topic of interest to you, this is a very objective list. We welcome you to download it. And also at that same spot on our website there under resources, you can get the full report. We only touched on certain parts of the research and analysis, and you can get the full report there as well. So let's move on to questions, and I'm going to go through these. Someone has asked, are we going to show the platform? No, the purpose of this webinar was to talk about the data. We're obviously happy to talk with you at any point in the future and go over what we do and certainly talk to you generally about your needs. And you can contact me or contact us. We're happy to do that. Let's see, the next question, how does data from Great Plains flow to FundCount? Well, as we said in that one part of the discussion, FundCount, and again, a lot of other systems have strong importing tools. If that is being used as the general ledger system, FundCount again can digest or consume any data points necessary. It really depends on the kinds of reporting that you would want then out of our platform versus what Great Plains is used for. But again, interoperability, export, import is it's table stakes at this point. Have to be able to do that to work in a customized way with any given organization. Let's see. So another question is, well, there's a question about the 5-year, the cost for a certain number of users. Again, happy to answer those questions in an offline conversation. Another question here is, many of your points today echo the pain you're in, but our struggle is coming up with an ROI to be able to persuade the patriarch we need to buy a system. Any suggestions on this? So, Paul, I'll throw that to you.
That's a really good question. So there's like 3 or 4 different approaches to this. One is you simply look at the fact that what you're doing today is probably not scalable, right? And sort of what your activity is, and it's often the case that you can make a case simply on the strength of not having to hire more people to get to where you need to. But another thing is, we've done studies like this in the past. The title of this paper is operational. We're talking about operational alpha, right? So
Right.
If you're managing a portfolio of assets and you're looking at your cost of technology and your cost of process, there's also a potential gain for that. And I have seen people speculate on what that potentially is in terms of basis points. There are papers out there where groups like the hedge fund industry have looked at this and said, look, there's a reason funds keep books inside, right? And they manage this stuff because they get something, some basis points in return for this. So I think there's the case to be made for that. Most importantly is the risk piece. If you are not able to report comprehensively on your portfolio in a timely manner, right? It's all fine as long as we're in a secular bull market, where it can only go up. But when you begin to experience risk, right, or when you begin to have to adjust to dramatic changes in the market, data matters. And so I'd say quality is the third area. Those are more soft factors, right? But each of those 3 areas has a return that can be modeled.
Right. So. Exactly. Great. Another question, what elements of running direct investments do family offices find particularly challenging? Are some jurisdictions worse than others? I guess what we find elements of running direct investments. It does have to do in particular with the general ledger accounting around those. So you want to be sure that you're going with a system that is pretty robust in just general ledger accounting and accounts payable and things like that. Doesn't necessarily have to have all of the depreciation capabilities and budgeting and things like that, but that is being able to then integrate those direct investments and the performance measurement on that in the context of other investments is challenging, and so that's typically why we find that FOs go to an integrated approach. And jurisdictions, I guess I would leave that more for your experience, Paul or Steve.
Happy to comment. Steve, so I mean, I would say Steve, I'm hesitant because I know you're sitting in the UK, and one of the things we see, for example, is just simply differences in the way assets are handled from a tax standpoint, right? So in the US, there are differences like that. The other thing I'm surprised that's crucial, of course, is currency, right? So if the system has its roots in the offshore world and it was designed from the start to handle currency, it matters. Yep. Surprisingly large numbers of US based platforms are not really multi-currency enabled. They're simply throwing an overlay on of, yes, I can translate, this into dollars, but they're not really accounting platforms that can do that on an operational basis. They haven't got the reporting in place. They don't consider the performance attribution aspects of currency. So all of those things are things that systems should have its roots in the global market if you want to really understand those things. Those aren't exactly direct investment things, but they all certainly relate to it.
Yes, exactly. Well, we have gone a couple of minutes over. I appreciate those of you that have hung in with us for this extra time of a couple of minutes. It's been really great working with you and your crew, Steve and Paul. Thank you for joining us today, and this has been really a great experience. We hope all of you found it to be as well. And again, we're happy to answer any questions, and we welcome you, invite you to download the report. They're in the resource area of fundcount.com. So with that, we'll bid you adieu. Thank you for joining us.
Thank you.
Thank you very much. Thanks, Mike. Thanks, Paul.
Cheers.
Thank you.